Hi guys, I'm Gretel Slater, Associate Advisor here at Kimber Capital. I just wanted to summarise some market news this week and things that I found interesting in the overall market. Let's start with the strategic 5-year cost-cutting announcement that NAB made yesterday. The aim is to enhance their earnings by up to 800 million, but it'll be a slow burn. All the banks are scrabbling at the moment to beat down their cost-to-income income ratios. Because in a low growth economy, it's the best way to make a profit. The announcement comes as NAB tries to move away from traditional branch banking into internet-based banking, mobile. Most people trade online these days. So all the other big banks have moved more in that direction, so NAB's now catching up with them. NAB has been a laggard in the sector over the last several years, and the announcement yesterday wasn't received particularly well by the market, with NAB being down 2%. However, overall, investors still seem to be entranced by bank stocks and the dividend yield that comes with investing in this sector. And that is even considering that the bank price-earning ratios are all trading on what looks to be a very expensive 14 times. Not to mention the price-to-book ratio, which is the traditional way of valuing a bank, is an expensive 2.3 times. CBA has traded as high as $70, and believe it or not, CBA's market weighting is now bigger than BHP's Australian market weighting. Also, CBA's market cap is now bigger than that of all the German banks, which gives you a pretty good indication of how sweet Australian banks have got it at the moment. The question we have is whether the default trade of long banks and short resources over the last 18 months is still the best way to go, or whether it's coming to an end, or is it just, the beginning. There's much to say the weight of money still sitting on the sidelines in term deposits will eventually make its way back into the market, mostly in bank stocks. And perhaps CBA could even reach $80 in this circumstance. But for us, the key resource stocks, BHP, Rio and Fortescue, are very cheap valuation-wise when compared with the banks, and each day the gap widens between them and the bank stocks. Our thinking is that it's time to sell a little of the expensive and buy a little of the cheap. We think that much of the volatility created in resources at the moment is because of misunderstood figures coming out of China. Traders are selling first and asking later whether the numbers are good or bad. And this only creates uncertainty. Uncertainty means that lower prices are coming out of the resource industry, which means that it's time for us to take advantage of buying some of these stocks.